Welcome back. Well, this is the second segment that we have on Commodity Town Hall, where we are going to be talking to Kishore Narne, who's Director and Head Commodities, Motilal Oswal Financial Services. Kishore, hi, thank you so much for joining in. There is just so much uncertainty into the international markets that most of the people or most of the investors right now want to understand on where are we standing right now, what is our current position, what is it that we are looking at in future? How do we mitigate this risk and this uncertainty? And what is the outlook that we are looking at into the markets? When it comes to commodities, really, this is the only segment that has given you a long position and a shorting opportunity as well.
Yeah.
How have you seen commodities in last 6 weeks especially?
See, I can put it, this journey is started in 22 actually.
The gold bullish, the commodity bullishness.
The theme of de-dollarization actually.
Okay.
That's one of the predominant backbone of the commodity rally actually, right? So dollar is nothing but a currency which was backed by gold at one point of time. After President Nixon removed it from the dollar peg, something has to be anchored. Otherwise, nobody really would have valued dollar. So the pricing of oil in dollar actually made the entire global oil reserves as the backing of the dollar. It's just removed that gold and the oil is now the backing of the dollar because you can purchase oil in dollar terms. That's the only way you can do it. So that actually anchored. So that anchor has been destabilized for the first time in 22 and onwards, where people started to see that, okay, for a global trade, we don't really need dollar. We should actually move away from dollar and look for some new ways of doing it. So that's what de-dollarization actually triggered. Especially the BRICS nations actually started adopting that. Some of the other small group of nations started adopting it. And so in turn, people started to deviate their reserves also from dollar terms to something else. So China started, India followed, all those things. So that was the predominant anchor point. From there, which we should see the current rally. And generally, in a macro trend, commodities are like a 8 to 12 year kind of cycles.
Right.
So the super cycle, the large cycle. So in between, you have a couple of years of uptrend, downtrend, all those things will keep coming if you remove the aspects of war and all those things. But the general cycles are 2 to 3 years short-term cycle.
So where are we in that cycle right now?
I think we are in the somewhere in the top of this first cycle. Right? We should see some consolidation, but consolidation depends on what kind of, because see, commodities are no longer demand-supply situation, demand-supply story. I think that's what I will be explaining you. The entire context of analyzing commodities, which we used to do as a demand versus supply, total availability, total demand. I think we have to throw away that theory, and now it's different. It's strategic importance. You want to hold more commodities. I don't want to dependent supply chains. All these geopolitics came into a bigger play. I think that's going to be the theme for the next 2 years.
All right. So why don't you walk up to that screen there and tell us on what do you think about commodities and what really are your targets when you look at all of those commodities. So what we'll do is we'll start with this short presentation. And of course, we have guests in studio. We'll be asking questions to Kishore as well. But Kishore, please take it away.
Yeah. So I think the entire theme is what has transpired into commodity rally is something where we are into is what I named it as the great decoupling is, especially the decoupling means we are actually decoupling from what the traditional commodities has been running, and the entire story is now about geopolitics. Has nothing to do with demand and supply. You might have abundant supply. For example, oil, we have abundant supply actually. We have oversupplied market, but still geopolitics actually triggers a price rally from $60 to $120. So that has nothing to do with supply, right? So currently, this is just a slide which shows you where we stand: $4,700, $4,800 in gold, 77 is silver, around 91, 92 Brent, and around $12,000 is the copper. So this is where we are standing currently. So the bigger thing is one of the things which we are looking at is supply vacuum created by geopolitics. So Qatar LNG facility, that's 17% LNG, of course we all have seen on the news, it will take around 5 years roughly to come back. So 17% is wiped off of the largest producer of LNG. So in aluminum, Middle East becomes extremely important. It's a swing producer. Aluminum, the total input, roughly around 60% of input is power. Only 40% is metal. So if you have, let's say, 40 rupees worth of metal or refining ore, and you need 60 rupees worth of power to make 100 rupees worth of aluminum, right? So basically, the largest component which goes into aluminum is actually power. So power is produced by gas. So Qatar and UAE, where we have abundant gas resource, they built aluminum smelters because they wanted to use their excess gas rather than selling gas to somebody else to smelt aluminum. Why can't I build my aluminum plants? And because the Middle East became trading hub of the world, they are able to sell this metal to everywhere. And suddenly that metal became stuck in the geopolitics. So 2 of the aluminum plants have been struck by drone attacks. That has gone down. Second, there was no shipping lines available. So that actually taken away the availability. Third is that global, around roughly 9% of global aluminum supply has been impacted from the Strait of Hormuz. So it's not only oil, it's also aluminum. And that actually caused aluminum prices to go to around 4-year high. And that has nothing to do with, so Middle East doesn't have any aluminum actually before few years back, right? So the consequences of that are very, very different. And on the macro front, as she was mentioning that about the dollar and all, so this impact on Europe has been phenomenal, far higher than any other place of the world, because Europe imports energy, gas, and also aluminum and also other metals. They don't have manufacturing facilities enough to supply to them. They are dependent on Middle East. They stopped Russian gas, so they are dependent on Qatar gas. Everything has turned around. So around roughly energy prices went up by around 4-5% in Europe, which actually caused their 2% CPI inflation to 2.5% in only 3 months. So suddenly their target inflation rate now is it's postponed or delayed. Even US, for that matter, I think US 2% inflation rate, which was anticipated in this year, I think we are pushing it back to around somewhere around end of first half of 27, they might be able to achieve 2% inflation rate. So inflation now comes again forefront of the things. Otherwise, we are all anticipating that rate cuts will happen, interest rates will come down. That was the primary theme. But one more thing which I want to say is that especially in gold, the rally in gold happened in the last 2 years, especially more than 140% rally has happened in 2 years. So in 2 years, the bond yields, especially 10-year GSEC, recently we have touched around 4.4, 4.5, which is again a multi-decade high of US. It's a big conundrum and also paradox. Gold should not perform when interest rates are higher. The bond yields are extremely high. Gold should not perform. We were close to very close to all-time high before the correction came, and still bond prices were around 4.3, 4.4. The bond 10-year GSEC yields. So this is a conundrum. Why it was happening? It was not interest rates which were driving, and a lot of analysts who were actually banking saying that gold was rallying in anticipation of rate cuts. No, it was not rallying in anticipation of rate cuts. It was performing on its own despite a high interest rate payments, despite costly money, expensive money. It was performing because of the de-dollarization, because of central banks substituting gold, and how much they are able to do. So 2 years back, 24 months, exactly 24 months if you take, the total amount of gold in central bank reserves was 12%. Today it is around 15%. So only 3% shifted and gold went up by more than double. So 3% shift of global reserve has caused rally to go up, and we are anticipating the 15% will go to 25% in the next few years. I don't know whether it will take 7 years or it will take 10 years. So 15% will go to 25%. That's my take on how central banks will be diversifying their reserves. So you can imagine what can happen to gold. And I think the previous guests were also talking about the US debt, $39 trillion of debt. And what happens if US has to pay this $39 trillion debt? How it can pay? There are only 2 ways you can pay. For example, you have, as a household, you have debt, you have to pay. how you can pay. Either you, if you have any resource, suddenly you find what you call gold reserves under your floor, or some chupa hua paisa mil gaya, or you create output out of your family, right? You produce more so that you save more and pay off your debt, right? So can US do substantial outperformance to the gold to the world and significant higher GDP and export this GDP and make money and pay off this debt?
Right.
Can it be possible? Trump is trying his best to do this, but it's not easy and it's not quick. And if at all there is inflationary pressure, if there is any interest rate hike from here, that is again, they have to pay on this $39 trillion also. It is a significant problem for them. So the only other way, only US can do, rest of the countries cannot do, is print dollars and pay off this debt. Simple. Nobody is going to ask you, print as many dollars and pay off this debt.
So with that kind of a scenario, where are we headed really in sense of prices?
That's what the last sentence, you can see that.
Okay.
If I had to monetize this $39 trillion debt, that is a mathematical equivalent of $10,600 in gold.
And so how are you looking at prices going forward on this one then? I think that is your next slide really, and that is what everybody is waiting for right now.
So energy, I think everybody knows about energy. I think that we don't need to spend too much of time because it's not controlled by any fundamentals.
We've been talking about it day in and day out.
This is headline news.
Yes.
Headlines is going to control. This is an interesting story which is happening in metals. Copper is super strong. And it has nothing to do with construction, nothing to do with housing, because traditionally copper was run by industrial production and housing markets. Chinese housing markets has collapsed in the last 3-4 years. Nothing is happening. Industrial production is not growing, but still copper will perform because, and aluminum, both are very, very strong, just backed by data centers. Data centers has two requirements. Of course, the chips are there, but the cooling is the biggest requirement. So power and refrigeration or the cooling, right? So the entire refrigeration units are made of copper or aluminum heat sinks. You need significant aluminum heat sinks. And the amount of power which a single mega data center consumes is roughly around 132,000 EVs can consume, one data center consume in a day, right? That kind of power is needed. So power grids have to be upgraded. Power grids need a lot of aluminum. Right? And copper is replacing aluminum is replacing copper in many places, because if you see traditionally copper to aluminum ratio is roughly around 2.83. Beyond 3.5, because the copper is 3.5 times of aluminum, ton to ton pricing. Then in anywhere, wherever copper is used for wiring, etc., that is replaced by aluminum. So currently the ratio is 4.2, not even 3.5. So copper is 4.2 times of aluminum. So aluminum is a big story coming up, right? These are small metals, but as far as the outlook is concerned, I'm again putting around 12 to 18 months. It's not short term, of course, right? Slightly longer term. Floor I'm looking at for gold is around roughly $4,300, right? And ceiling roughly around $6,800, $7,000. That's the medium term. I can say 18 months, right? 18 to 24 months or kind of thing. Silver, anywhere around 79, 80 it is getting stuck. It's problem. If it has to sustain, it has to sustain about 80. I think we will take around May, June, somewhere down the line, where it will start a new rally. 120 is the base case scenario, $120, 140, 150 also is possible, right? Gold silver ratio is very in the middle, 61 times. Still silver has more this thing. Copper up to 2030 there is a structural deficit in copper. So it will continue to be performed. It's a strong metal. Aluminum, again, Gulf supply is off, so that's Rusal is also off. Actually, Russian supply is also off. Gulf supply is also off in aluminum. And migration from aluminum to copper is copper to aluminum is happening. So that's where aluminum comes into play. The new demand is getting created. Crude, it will continue to be volatile. It has nothing to do with demand and supply. And probably if the ceasefire doesn't hold, we are back to 120. And if the fighting goes for another 30 days, we'll be at 150. We'll see. And Gas actually, because US is replacing the Middle East gas. So there is a big difference between this side of the Atlantic and that side of the Atlantic. But I think it's a short-term phenomenon. If the Qatari gas comes back, actually gas doesn't have any big upside. So metals is the market where I would like to be. That's what is the trend.
All right, Kishore, have a seat. And as we have questions getting readied and mic being passed across, you know, you're bullish on a lot of commodities there, but I did see strongly bullish on some of those commodities as well. So if you had to list up all of these commodities in sense of price gains going forward in 12 to 18 months, how are you going to stack it?
See, I put them into two baskets, structural and tactical.
All right.
Structural, copper and aluminum are structural trend. So you will not have a sudden spike or a big movement there. You will have a linear progression. You will have 20-30% every year for the next few years, because that's where the structural trend is there. Gold, again, a structural rally. I don't see this is the short-term blip it has, and it's a great opportunity.
Still good to have 10% in your portfolio for gold?
I'm suggesting 25%.
Oh, wow. Okay.
Yeah. So, and I'm having. So it has to be.
And what is 75% of your portfolio?
See, there are two types of portfolios I'm suggesting right now. 50%, India is still great. Large cap, frontline stocks. Around, if you are going to keep 15% gold, go 15% to global markets, especially US equities. Go to US equities. You are allowed under LRS scheme. There are a lot of brokers, including us, allow that. So you can go to US equities. You can participate. The major new GDP is getting created in AI boom.
Absolutely.
You have to participate in AI boom. So you go to US markets and participate in that AI boom. And around 15% into debt. And around 5% to 10% dry powder you need.
Okay.
So that's the portfolio.
All right. Any questions that we have on metals? Yes, yes. Can we pass on a mic, please?
So my question was on...
We'll have to take this on a mic. It's just coming to you.
So now I have three questions, actually. One is, the joker in the pack was the US debt. Yeah. And there's been a lot of chatter about the gold reserves, which US has the largest gold reserves in the world. 70% of their forex is gold. So in that context, about their valuation is at less than 20% of the market value. And if they revalue to market, that could change the dynamics. So how far is that chatter possible over some time to come, given the Marwick president that you have today?
See, debt has to be paid in cash. You cannot just adjust a balance sheet entry. You have to pay. Either you have to sell gold or give away the gold, right? Just by revaluing your balance sheet doesn't take off your debt, right? So if they want to pay in gold, I don't assume that they will be doing. They would like to pay at $10,000 rather than at $5,000. They will hold it few more years, and it's better to pay that at a $10,000, or I print more money. So nobody is going to stop them from printing money now. And they have shown that in COVID also they shown before when 2008, Lehman crisis, PIGS crisis, European crisis in 2012, every time they shown that they can print anything and they can escape from the inflation also.
So, all right, I'm sure we have a lot more questions, but that's all.
The second question was on...
I would rather have him ask a question, please.
Yeah. He already has.
My name is Siddharth Shroff. My question is, does technical analysis work in commodities over a period of 3 to 5 years or 10 years, especially for gold and silver and other commodities?
So
how do we have technical analysis in equities? Does technical analysis work in commodities?
Gold and silver.
So technical analysis was invented in commodities and adopted in equities. So the Japanese candlesticks you see is invented in rice trading in Japan, right? And if you see the CBOT, the Chicago Board of Trade, 1860, 1830, when the technicals were started. So technicals is nothing but putting human behavior, the collective crowd behavior into a kind of a chart and try to analyze how the crowd is seeing the market, right? That's technicals. Commodities, if you remove some of these extreme volatilities, generally are very, very linear in nature. It gives you very highly predictable trends. equities has actually much more spikes. If you see the candlesticks and the shadows will be much longer, the tails will be much longer. Here it will not be like that. So it's very highly predictable, number one. Number two, as far as timing is concerned, when you said that can it give me 3 to 5 years outlook, 3 to 5 years you are shooting into the dark actually, right? So until unless you understand there is something fundamental also. And a chart doesn't know whether the candle, when you are looking at patterns, you look at a pattern, whether it's a 5-minute chart or a 5-year chart, it doesn't matter, right?
All right, I'm really sorry, but that's all the time that we have on this segment. Thank you so much, Kishore, for joining in. We will go into a short break, but don't go anywhere because we will be joined by Vikas Kumar Jain of CLSA and Anand Shah of ICICI Prudential AMC when we return. And joining them on the stage, of course, is going to be Nigel and Nimesh right here. Welcome, guys.